I think that for the last 20 years, stocks were considered a sucker's game.
Yeah.
Right? Because people invested in alternatives, bonds, and thought great blue chip companies were just a sucker's game.
Or whenever they went up, they were riskier.
Yeah.
Right.
And that they'd crash anytime. But I think COVID showed these companies aren't killable. We might be in a period where PEs go up a lot in the next decade.
Tom, we're going to start with what you thought was the biggest surprise of 2021. And by the way, not that you were very surprised by this year, because you seem to have gotten this year mostly right from the outset, which we're going to get into in a second. But what would you say was the thing that was most surprising to you?
I would say if I went to the highest level and was trying to look down at the market, I think the resilience of the stock market is the biggest surprise.
But where was your target in January?
Might have been to like 4,600.
Nailed it.
And where are we
Right
as
there.
of today?
46.
So that wasn't a surprise to you at all. You're like a wizard. You
Yeah.
nailed it.
But that's a 20%. Like we're at a 20% kind of year.
Okay, so was that like a stretch? Was that like a stretch target for you, or you felt really good about it?
So I'm working on my 2022 outlook. So I'm been looking at what we said for 2021.
No spoilers.
No, we're all going to
Yeah.
spoil that.
But it turns out that the base case is 24% year.
Okay.
Because the biggest reason is that we expected volatility to collapse.
And that was the case for most of this year.
We got two
Correct.
VIX spikes, but they were both kind of baby spikes.
Yeah, so the VIX averaged in 2020 at over 27.
Most of that's from Q1.
Correct.
But it stayed elevated though. The whole didn't right.
Yeah, it didn't drop. It was the third highest ever for delivered vol. And so in the two prior instances when vol drops, you had a 25% average gain.
Okay.
So that was our base case this year.
Okay, so you were looking at it like, look, we know we're not done with COVID. We know we're not done with a lot of the problems of reopening, but it's unlikely to have an average VIX as high as the one from 2020.
Correct. Yeah, so you'd have to really keep the level of anxiety high enough to keep an average VIX at 27. And this year we're probably averaging 16 or 18, and that drop is a re-rating of the stock market.
So volatility plays a big role in your forward-looking analysis.
In certain moments, like now
Yeah.
where we are here for next year, volatility is not central to our thinking now, to how markets can perform.
Okay. So how do you know when to take that into account or not?
It's a sort of a signal from noise
Okay.
thing, which means it's same thing with like AAII sentiment. It doesn't mean anything until it gets to an extreme.
One way or the other.
Yeah.
Okay. We're going to talk about sentiment a little bit later. What's your big surprise for this year?
I've got a few. I don't want to hijack too much of this, but I'm surprised at how quickly everybody was right on the ARK story. ARK had all of the attention in 2020 outside of COVID, like just on the stock market side. Sucked all the oxygen out of the room, and I'm surprised at how quickly it gave a lot of it back, and that everybody, all of the people that have been on Wall Street for more than 2 years, were waiting for the young people to have their comeuppance, and it happened so quickly.
And so obviously it's like indisputable at this point. Like what are the stats on ARK? How much is it down from its peak?
A lot, 40, I think.
And there are some individual stocks in there that are down like 60.
I mean,
60.
So one other thing surprised me, and maybe this shouldn't, but Carl Quintanilla tweeted this the other day. The percentage of total household assets and equities is like so far above what it's ever been. And given where we came from last year, this is an interesting chart.
And that's with housing prices way higher too.
That's true. That's a good point.
Which
so for
makes it even
context,
more pronounced.
for context, this peaked in 99 at around 21%. And I don't know exactly how this is measured, but we're bumping up against 25%. Indisputably, and this chart goes back a long time, indisputably, it's not bullish when households are this aggressive. I do think you could easily make the case that it's different this time.
Well, yeah, and I would say that my only issue with charts like this is it's based on assuming you have to do a forced ranking, like a forced allocation. What do you
mean by that?
That means when you do percentage to 100, right? This is percentage in equities. Then households don't necessarily make a conscious asset allocation decision.
Right.
So equities can become a large percentage because they never sell.
And they've gone up a lot.
Yeah, but they don't have to necessarily allocate more. Equities can just compound.
Okay.
And so if your equity is compounding faster than your net worth, it's going to actually rise.
So what this is not showing is like flows, for example.
Yeah,
This doesn't necessarily show people getting all balled up.
Yeah, so they're not necessarily forced to rebalance. Like nobody every year says my household net worth, I need to reallocate out of stocks.
Yeah, I'm going to trim some of my house and buy some more stocks.
Yeah.
That's a good point. People don't look at their household net worth, their household total assets, whatever this is showing, and say like, I'm underweight stocks relative to where I want it to be.
Yeah, I mean,
Relative to my primary mortgage, nobody says that.
And then if you throw crypto in there, like then you're going to automatically say, well, crypto has already broken the the scale because it's never been this high.
Well, so the other thing is, isn't this just a concurrent indicator?
It's like margin debt.
Yeah, yeah, of course stocks are a higher percentage, not because people got more bullish, but because they went up the.
Correct.
Yeah.
That's
so
exactly
that's what Tom's saying. What's your biggest surprise? Do you have one?
My biggest surprise is that we got through that Delta variant without having to like do the whole Great Depression conversation all over again. I really did not think we would be able to shake that off to the degree that we did. And none of the work from home stocks worked during Delta. Like they started to crash.
When was
prior to
Delta? Was that spring? Was that
July.
made in July?
It peaked in September, but it started in July.
You're looking at the chart, you don't even see it.
If you were like, everybody's selling off these work from home stocks, they're going to be wrong. COVID's about to make a comeback or a new wave. So that did happen, and those stocks just continued to get killed.
Yeah. I think one difference is with each variant, there's an expiration date. Like the Delta burned out.
Yeah.
And Omicron will burn out.
I mean, Delta did a lot of damage. More people died in 21 than 20 from the pandemic in America, and I'm not sure if that's true globally. I know that's true here. So it burns out, but like, not before it
takes
burns.
a lot of people with it. Yeah.
Here's another chart I want to talk about. Throw this one up from Katie Greifeld. This is a quote from J.P. Morgan's Clinton Warren. We have clients calling in historically when the market pulled back 10%, and then those clients calling to buy in at 5%, and now it's 2%. Any 2% move or so, clients are getting in.
Who's Katie Greifeld?
She works for Bloomberg. So just the relentless nature of clients waiting to buy the dip. It seems like, again, to this point, it was 10% will get in. Now it's 5%. I mean, they are just, the dip buyers are relentlessly showing up. That's been surprising to me as well.
Yeah. I mean, that's a 1990s phenomenon because I was at Smith Barney in the 90s, and Smith Barney is wirehouse plus institutional. And Quinton Stevens, who was head of equity capital markets, we'd have like a weekly huddle, and every time the market was down a little bit, he'd just tell us how much money came in from retail. And
yeah,
Josh, a week or two ago, we were like joking, like, is this it? Like, did the stock market just bottom? And the S&P was off 5%. The NASDAQ was off 7%. Now, of course, a lot of the high flyers were down 70%. So, but that was the bottom, and the market just made a new high yesterday.
Two questions. Did the stock market bottom, or did Apple and Microsoft bottom? It's two entirely different questions. So, and one of them has more importance to the S&P 500 than the other. So we've had this phenomenon now, I think, for 6 months with deteriorating breadth.
yeah,
There is a rotation. There is a new group of stocks that have led in the last 6 months, but they're not that important or big. The only thing that really matters if you're talking about, quote unquote, the market is Apple and Microsoft. For how much longer can that continue?
And the giant financials, like that's a big piece of the market too. Those are working.
What's the biggest financial? Berkshire is $600 billion.
Okay.
Goldman is $150 billion. You're going to tell me that matters?
JP Morgan, Berkshire, Bank of America, they do matter.
Okay, combined.
They matter.
Right. Fair. All right. So do you think that do you think that this is just a learned behavior, this automatic buying of the dip after 2% because it's worked for so long and people don't know anything else?
I think that for the last 20 years, stocks were considered a sucker's game.
Yeah.
Right? Because people invested in alternatives, bonds, and thought great blue chip companies were just a sucker's game.
Or whenever they went up, they were riskier.
Yeah.
Right.
And that they'd crash anytime. But I think COVID showed these companies aren't killable. We might be in a period where PEs go up a lot in the next decade. So
So that
Here's another.
that was kind of the thesis behind the Dow 36,000 book, which I think came out in 97 or 98, where they basically said, no, it's not that stocks can just become overvalued forever. It's that they've been undervalued for too long. And not that they were proven right or anything, but that was that same idea, which is that we have systematically been pricing blue chip U.S. companies at too low of a multiple for the history of the stock market, given how much return we've gotten from them. And that was their big idea. So my big surprise I wanted to just throw out quickly was the IPO market. 399 IPOs in 2021 raised a combined $142.5 billion.
Worth now a combined $90 billion.
Well, we'll get to that in a sec. The busiest year by deal count since 2000, even though a lot of those are SPACs, they're still deals.
Yeah.
The biggest year for proceeds of all time.
wow.
27 of those deals were $1 billion plus. The biggest one being Rivian, which raised $12 billion, which is the largest since Alibaba 7 years ago.
What else was big this year? I can't really remember that many.
I think Coinbase, Robinhood.
Those are 21. That's right.
These are 21 vintage.
Yeah.
I mean, Rivian is so enormous. But were you surprised at all by the strength in demand for new issues, or does that just go hand in hand with an up market? Is it just as simple as that?
Well, the companies you described are actually in growth areas. So I think it would be appropriate that, like there's going to be big deals because these are like, if you remember like the Philip Morris, like the deals in the 90s, which is big conglomerations.
Yeah.
That's a different kind of capital raise than
Yes.
growth companies.
Right.
I don't know if the EV space is overcapitalized now, but there were a ton there. Crypto I think is still early, so I don't think you can overcapitalize crypto at the moment.
Do you notice that the same people who were wringing their hands about too much private equity take privates? Like, they're taking all the stocks off the market. This is terrible.
That's too many.
Then you flip the switch, you get 400 IPOs in a year, and I don't know what last year was, probably 250 or 300. It's like, oh no, there's too much deals. Well, Goldilocks, how many deals would you like? What would be the optimal amount? I'm sure you hear a lot of that chatter or get asked questions about that kind of thing.
Yeah. So here's the thing. I am struggling with some of these high level math numbers because the numbers are just so big now. Like household net worth is 600% of GDP.
Yeah.
But it's not as if household net worth is overcapitalized. It's just that's how rich Americans are.
Yeah.
That that 600% GDP is so big you don't actually need capitalism
Wait,
anymore.
household net worth.
To GDP.
So deduct mortgages, deduct credit card debt, just the assets themselves.
Yeah, so if you took let's
Net
say
of.
Yeah, so US economy is let's say 25 trillion.
Okay.
Household net worth is 143 trillion.
How is that possible?
So
Crypto. Do it. Say it. Blockchain.
Crypto's only 2 trillion of that.
Okay.
But that number is like a real that's actual residual book value.
What was that number in the 60s or the 80s or sometime?
It's never been this high.
Well, I don't know if this is exactly right. This is household and nonprofit organizations' net worth divided by GDP. Is that sort of the chart you're talking about?
No, because if it's updated, it is all-time high. I'll pull it up on my phone. I can ask Mike.
Yeah, while he's doing that, this surprised the hell out of me as well. The S&P 500 was up 18% last year.
Yeah.
I think it was up 30% the year before that.
Yeah.
It's up 26% this year. Does it not
No,
only
it
does
doesn't
it
feel like that.
not feel like that? Guess what? The equal weight version of the S&P is up the exact same amount. It's not just mega cap stocks. They're each up 26.4% as of today.
I would not have guessed that. That's a big 2021 surprise.
26%.
Right now.
That's a raging bull market.
Yeah. I mean, there are very few years way better than this.
Yeah.
Right? 2019 was an amazing year. This is coming pretty close.